Hello traders, in this video we will be looking at commodity prices and how they affect movement of currency prices in the forex market. As you watch the video, you will be able to understand how the price of gold and oil determine the movement of various currencies and the correlations resulting from price fluctuations affect the general forex market. Kindly remember to subscribe. In some instances, traders just trade the charts, failing to understand that the prices of commodities have significant influence on movement of currencies in the forex market. This happens because a lot of countries heavily rely on exporting commodities for their economic growth, which naturally ties the value of their currencies to these commodity prices. Typically, it is worth mentioning that while most currencies are affected by commodity prices to some extent, the ones that are most influenced are the Australian dollar, the Canadian dollar, and the New Zealand dollar. At the same time, the Japanese yen and the Swiss franc are also significantly impacted by changes in commodity prices. We have to mention that it is important that forex traders trading in these currencies get a clear understanding on the correlation between these currencies and various commodities when trading. This is because the exchange rates of these currencies tend to change in response to shifts in the commodity prices. So some of the areas that we are looking at, or some of the correlations that we will be looking at, include oil and the Canadian dollar, oil versus Canadian dollar Japanese yen correlation, the US dollar versus gold and oil, and finally gold versus the Australian dollar versus the Swiss franc. So the first correlation we take a look at is the relationship between oil prices and the Canadian dollar. The Canadian dollar is greatly influenced by ups and downs of oil prices since Canada is a net exporter of oil. Typically, when oil prices drop, it often leads to the Canadian dollar losing value in comparison to other major currencies. Similarly, when oil prices go up, then the Canadian dollar also goes up. When oil prices drop, it affects the Canadian economy because it earns less money from its oil-related businesses. As a result, the Canadian dollar tends to lose value in comparison to other currencies. Conversely, when oil prices go up, the Canadian dollar tends to strengthen because it leads to higher revenues from selling of oil. The other correlation we will be looking at is that of oil versus the Canadian dollar and the Japanese yen. So we see that, on the other hand, Japan is a net oil importer. Japan, being a net oil importer, is also significantly influenced by changes in oil prices. For example, when oil prices fall, the Japanese yen tends to increase in value because it becomes cheaper to purchase 1 barrel of oil using the yen currency. On the other hand, when oil prices increase or rise, the Japanese yen tends to weaken because it takes more Japanese yens to buy 1 barrel of oil. If we consider a country's oil trade balance, it will be evident that the Canadian dollar against the Japanese yen is an attractive currency pair for traders to trade. When oil prices go up, traders often go long on Canadian dollar Japanese yen pair, as higher oil prices typically lead to appreciation of the Canadian dollar. At the same time, when oil prices decline, traders will go short on this pair because the Japanese yen tends to strengthen due to the reduced cost of buying a barrel of oil. So let's take a look at gold against the Australian dollar versus the Swiss franc, or gold versus the Australian dollar versus Swiss franc. We see, or typically, fluctuations in gold prices often have a notable impact on the value of the Australian dollar in the forex market. This results due to the fact that Australia is one of the world's leading producers of gold. Further, there is a direct correlation between gold prices and Australian dollar. In simple terms, when gold prices increase, or a rise in gold prices leads to appreciation of the Australian dollar. And when gold prices decline, then the Australian dollar also depreciates. So as you trade the forex market, it is highly imperative to understand this correlation, since such knowledge is beneficial to traders when making trading decisions involving these currency pairs as well as other currency pairs. In many ways, traders prefer trading gold in the commodity market to trading the Australian dollar in the forex market. This is partly because whenever gold price increases, the Australian dollar also tends to behave the same and increase in value. The Australian dollar appreciation with higher gold prices is down to the fact that the economy stands to generate more money from gold sales. This leads to a positive balance sheet. Similarly, a reduction in gold prices often results in weakness of the Australian dollar. Gold prices also share direct correlation with Swiss franc. Typically, gold has always been used as a hedge against risks in capital markets, which confers gold a safe haven status. At the same time, Swiss franc has also been viewed as a safe haven given the country's political stability. The fact that gold once backed the currency, or the Swiss franc, also makes there to have a direct correlation between the two. Typically, the Swiss franc will always tend to appreciate whenever gold prices are rising, and whenever the gold prices are falling, then the Swiss franc will also tend to depreciate. Then, as we look at this, we cannot forget to look at the US dollar. since it is the one's reserve currency. So let's take a look at the US dollar versus gold and oil in the global markets. We will see that the US dollar is the one's reserve currency, as we have mentioned. And by being the global reserve currency, the US dollar influences gold and oil prices to a great extent. For example, whenever the dollar strengthens against other major currencies, the net effect is a decline in gold and oil prices in the commodity marketplace. The strengthening of the US dollar essentially means holders require only a small amount of the dollar to buy an ounce of gold or a barrel of oil. In this instance, oil and gold prices tend to become much lower in response to dollar strength. On the other hand, the strengthening of the US dollar is often associated with US economy's strength and resilience. The net result is that traders in currency market tend to buy the dollar, which leads to strengthening it as they trade it or as they buy it. At the same time, they are usually avoiding to trade oil and gold in the commodity marketplace. In the same manner, whenever the dollar is weakening against the major currencies, the net result is an increase in US dollar needed, or US dollars that are needed to buy an ounce of gold or a barrel of oil. As a result, oil and gold prices tend to become more expensive relative to the depreciating dollar. Or rather, in Forex markets or Forex charts, you will see oil and gold prices going up as the value of the dollar depreciates or falls. A weaker dollar is associated with weakness in the US economy, which often elicits concerns in the capital markets. Concerns about the health of the US economy often cause traders to invest in gold, since it is a safe haven. Usually, they are trying to hedge against the risk in the market by investing in gold, which is a safe haven. So it is worthy that traders take note of the correlations between the commodity price and the effect it has on the Forex market. We would like to recommend that Forex traders bear an understanding that commodity prices and Forex market movement always have a significant correlation. The best way to use commodity prices is to keep an eye on oil and gold prices when trading some of the currencies in Forex market. As we have noted, some of the currencies that it will be important to take a keen eye on when trading include the Canadian dollar, the Australian dollar, and Canadian dollar Japanese yen pair, since they have a great correlation with the movement of such commodities. And generally, the movement in commodity prices have an impact on the entire Forex market. So you cannot trade blindly without having this knowledge on commodity prices. Thank you for watching, and let us meet in the next video.